Cool and Dre. Big blunts, dope boys wanna smoke with me. Now we ride double M's through the whole city. Niggas talking down, but they always feel me. A 9-figure nigga, all I wanna talk is business. I seen a big mouth get a closed casket. Self-made, took over the whole racket. A kilo after kilo, see who moved the most. 200-foot yacht, she wanna see the coast.
Welcome back to the channel, guys. Goofy Investing, where we talk about investing in the stock market. All right, a lot of requests on this ticker symbol, so today we're going to be talking about GRAB. All right, ticker GRAB. This is a stock that trades on the Nasdaq for 26.05 billion, market cap $6.39 a share. So what is GRAB? Well, bottom line up front, it's pretty much the Uber of Asia, is pretty much how I take it. This is a company based out of Singapore, and they have geographical operations for their business model running in Cambodia, Indonesia, Malaysia, Myanmar, Philippines, Singapore, Thailand, Vietnam, etc. They got operations in South Korea. There's many more listed, but anyway, it's the Uber of Asia is how you got to think of it. All right, and when you're looking at the Uber of Asia, you have to think about different things, comparisons between Uber, Lyft, and Grab. These are pretty much the same business model. The same business model, but playing in different geographical locations. All right. Let's do a sniff check, look at some profitability metrics, valuation, balance sheet, financial statements, etc. So right off the bat, balance sheet looks great. All right, 7.35 billion debt or net cash and debt of 1.91 billion. Enterprise value is 20.61 billion, and once again, our market cap is 26.05 billion. Let's look at their actual growth rate and do a little sniff check on their PEG. So their forward PE on a non-GAAP basis is priced in for this growth rate, guys. All right. So they're set to do a little over 20% at the end of this year. Analyst consensus estimates got them doing shy of 20% at 19.22%. I think that there's a possibility they just do the same revenue growth rate as they did this year at 22%, if you will. Earnings. Let's talk about earnings performance. Earnings performance is pretty good. Neither miss nor a beat, just right on target. But as far as EPS is concerned, revenue, they've been getting some pretty decent beats or marginal decent beats here and there. The last time they missed on revenue consensus estimates on their earnings for revenue growth was Q2 of 2024. So not too bad. And then before that, they've had a slew of revenue earnings beats for revenue growth. And the last time before that was Q4 of 2021. So given the company's track record, their operations of growing sales, they're doing pretty good. All right. The odds are in your favor as an investor that these guys are going to come in and beat revenue growth rates. All right. So financial statements. All right. Growth looks good on the top line. I'm seeing R&D is nice and flat-ish. All right. So that's something I like to see. SG&A going down. All right. Operating income still negative. All right. As far as net income concerned, looking good on net income basis. They're positive. I'm not seeing any preferred shares. There are some derivatives that I've identified with this company. There's about 26 million warrants out there, and they're expiring the end of next year in December. All right. So that's something to consider. Those warrants I'm not tracking are, how do you say, they're redeemable at the company's discretion. So I expect those warrants to roll. I expect them to roll those warrants. There are some convertibles that were issued, and the proceeds of those convertibles will take a look at this earnings here. So they did do a raise on convertible notes, and they did the proceeds from that actual capital raise with those convertible notes. They opted to buy back $500 million dollars worth of stock. That's as good as it's going to get, though, guys. All right. So whenever a company decides to raise capital via convertibles and turn around and use that capital to buy back stock, they're pretty much signaling to the market that they think there's some limited upside in the actual next couple years. All right, 2 to 3 years is how I assess this management team is pretty much signaling to me. Of course, they're not going to say that. All right, now this is something where experience kicks in, and knowing how to read the actions of management teams and so forth. All right. That's pretty much what they're telling me. So, and as far as their free cash flow, let's look at some margins on this profile for this company. All right. Gross margin is 41.02%, while the sector median is 31.18. Uber, Lyft. Okay. We'll go to the comparisons here. We'll look at their actual margins on their gross. All right. Yep. Same idea. All right. Close to that 31 to 34 or 35% gross margin. So this company has a better gross margin profile than its competitors. They have superior leverage free cash flow margin. That free cash flow margin is very attractive. That's real shy of 30%. This is a real great cash flowing company. And of course, these EBIT to net income margin and EBITDA, these actual margins are not really, how do you say, they're not matured yet. All right. So those margins, there's room for expansion on those margins. If you look at the competitor of Uber, you got to think of Uber as more of a mature business model and the leader of this industry. And this is the mature margins that Uber is starting to realize. So if Grab's gross margin is superior and their leverage free cash flow margin is superior, I'm going to make the assumption that they're going to get better when they mature. They're going to have better margins than Uber's mature state right now. So their net income margin, you could be looking at 32% on this net income margin and on mature phase. How long does it take to mature? Well, I don't know. So here's something to consider, though. All right. Given their geographical location and the space that they're operating, I assess they hold moat versus Lyft and Uber. And this is why. A lot of these Asian countries, it's harder to get a car. All right. So, Singapore, for example, it's very expensive to have a car. It's highly regulated. You're limited on how many cars you can have and so forth. You have to go through the state, you have to pay all these fees, import costs of those vehicles, gas, and so forth, exported to Singapore. It's expensive stuff, guys. All right. So if you're an American, like I am, you kind of take these things for granted. You get your car when you're 18, and you pretty much, unless you live in New York City, it's pretty much a necessity to have a car. Singapore, they rely more on rails and buses and so forth, and it's a smaller country. And with that being said, that's one of the big reasons why regulations have kicked in to where it's hard to have a car. The Singaporeans are a richer economy, all right? So a lot of their comparison to their economic standing for their citizens, it's night and day difference. I mean, a Singaporean to an American, we pretty much assess them as rich. All right. So that's something to consider. I think that that business model is helping, that geographical location and the business model is helping this company command higher margins and increased moat. All right. And that's not to be said about all of the Asian countries, but a lot of them are like that. Some are going to be harder to acquire vehicles than others. South Korea, it's not impossible and to get a vehicle, but it's a little more expensive than the United States comparably. You might, you know, the actual cost may be 25% higher than the typical American as far as transportation and so forth. Okay, ownership. Not too much ownership here, guys, on the insiders, which is fine. Going down to the comparison between Lyft and Uber and Grab sales. So Lyft does about twice as much sales and trades multiples below Grab. Okay, so that's something to consider. Now, Grab and Grab is growing relatively similar to Lyft. Lyft has some more consensus estimates of slighter or lower growth rates. I'm not quite sure if I buy it. I think Lyft may grow a little faster, but the actual price you're paying for the growth is kind of night and day difference. We'll go back to consensus estimates. With these non-gap forward PEs to these growth rates, all right. And we'll take a look at Lyft right now and their consensus estimates. All right. You see these forward PEs are in the below 20s, and they're kind of what I'm trying to get at is the price you pay for growth is going to be, how do you say, more in line with Lyft, where Lyft, I don't think the growth is really priced in, and I think a lot of these numbers are lowballed from analysts. I think Lyft will probably grow faster than this. All right. And I could be wrong. Maybe the economy slows with these tariffs and the consumer slows down too. But the price you pay is really expensive. Valuation doesn't matter until it matters. Okay. Disclosure in the portfolio. We'll pull it up. All right. Here's the public portfolio that I built from scratch, from zero, a little over 3 years ago. We're up 107 G's, all right, since. And I am not a shareholder of the Grab company, all right? So there that is. You could take it to the bank. It's an unbiased review. 10K or 20F, because this is a foreign filing. Everything checks out. PCAOB regulated. Derivatives and warrants are all listed on here. And, this is another thing, going back to it. All right. As I said earlier. All right. So these warrants will be probably internally bought out by the company. And it's at the discretion of the company to actually decide whether they're going to buy them or roll them or what have you. It's part of the deal of the warrants. As you can see, 26 million warrants are out there, and they were issued out December 31st, 2024, with the expiration, like I said, end of the year, next year, December 1st, 2026. All right. So I don't foresee too much compression on the actual stock price with these warrants. I think the warrants are really a nothing burger. Their business model and the flywheel effect and the earnings call, I think that they're grabbing more attention with the grab more feature. And with the grab more feature, like in comparison to Uber, you can have the Uber rideshare, and then you can have Uber Eats. Uber Eats is where the person goes, picks up the food from some restaurant, and then comes over and delivers it to your house. The grab more is more of a function of, they do the grocery shopping, then they make a second stop, grab the actual restaurant food, and then they come to your residence and deliver your groceries and I guess lunch for the day or dinner for the day or whatever. All right. So I think that's pretty much like a knocking out two birds with one stone, proposition to the consumer. And I think that's boding well for them. Trip fare, they're trying to get these down. They're trying to get a lot of their business model is they're trying to make it to where the ride shares are as cheap as possible, and they operate through this actual app similar same idea to Uber, just a different flavor, if you will. All right. So I think that capital allocation and what they've been doing is pretty impressive with the convertibles and then doing a 500 million buyback. Balance sheet, management has been pretty good for this company, guys. All right. So cash is continuing to go up while actual debt is going down dramatically. All right. So um, their actual total common shareholder equity in the long term is going to grow naturally with their free cash flow margins. I mean, this is a pretty well run company and with everything that they've done. Um, so, with that being said, what do I think about the company? I think it's a little pricey, guys. I think there's better deals out there. That's just me. I'm not really too particularly interested in the actual grab stock. I think it could bode well and return significant shareholder value in the long run. Okay, short term, I think a lot of their performance, their price, and future projected earnings and all that good stuff. A lot of it is priced into the equity right now, guys. So that's just something to consider. I mean, if you're buying in right now, I mean, I think there's a little more risk than people think. All right. Could still turn out to be a good investment if you're holding long run. All right. If you're planning on holding this equity for 10 years, it doesn't really matter if you're buying right now at this little high. All right. So I think they do revert back to the actual mean up here since their IPO with the NASDAQ. I do think there will be an eventual double, though, in another 7 years or so. As long as they keep up with the growth rates and they do a little bit of margin expansion, and the market will just be happy with the performance. That's my take on Grab, guys. Hope you got a lot of value. Like and subscribe. Comment down below if you have any comments or questions. I will respond back. All right. Check out the Patreon. All right. $10 a month. You get investor development, a community of like-minded investors. I show you how to do price targeting, valuation analysis. I teach you how to value tech. I teach you the buy and sell game and the different intricate games that the financial institutions play with these retail investors. All right. Um, I'm always on there creating exclusive content. I'm always on there doing deep dives. You get access to those deep dives, and my ideology with the Patreon is to democratize all of the actual content, so all the members are going to be able to benefit, and so forth. And then eventually, when I get enough scale, I will grandfather and I'll grandfather all of those actual members within that time frame, and create value by creating another tier. All right. So thank you all for y'all support and y'all's interest in my channel. I hope you all stick with me in the long run and follow along in my journey to grow capital. With that being said, I love y'all and take it easy.